Item 2. Management's discussion and analysis of financial condition and results of operations. We are a high-performance cloud storage platform for data-intensive use cases in the artificial intelligence (AI) era and across a broad range of modern cloud workloads designed to help customers address complex storage needs by reducing the barriers of lock-in, complexity, and cost. Our mission is to make customers succeed by solving their toughest data storage challenges. We aim to achieve this mission through our purpose-built web-scale software infrastructure, which is essential to the global data center and compute infrastructure build-out. We provide cloud services through a purpose-built web-scale software infrastructure built on commodity hardware. We believe that by offering a cloud storage solution optimized for price to performance at scale, engineered for efficiency, and priced predictably, we substantially reduce the cost, complexity, and frustration of storing, using, and protecting data, and we empower customers to focus on their core business operations. We focus on specialized storage and an open cloud ecosystem that integrates with a broad range of partners. Ongoing investment in our technology platform and related features has driven customer, community, and product milestones. Customers use us to support their AI workflows, help ensure the cyber resilience of their organizations, streamline their media workflows, and enable a variety of other data-focused application and information technology (IT) needs. Through our blog and culture of transparency, we have built a community of millions of readers and brand advocates. Our direct sales activities, channel and technology partners, and referrals from our community of brand advocates, combined with our highly efficient and self-serve customer acquisition model, have allowed us to attract over 500,000 customers as of March 31, 2026, and our direct sales activities have historically supported us in acquiring larger customers, including leading neo-cloud platforms. As we continue expanding and accelerating our movement up market, we expect our direct sales activities to increasingly contribute to the acquisition of customers like these. Our customers use our Backblaze storage cloud platform across more than 175 countries to store and protect their data, with an aggregate of approximately 5 billion gigabytes of data storage under management. Our Backblaze storage cloud provides a platform that is the foundation for our B2 Cloud Storage Infrastructure as a Service (IaaS) offering. Our B2 Overdrive High Performance IaaS offering, our Powered by Backblaze White Label IaaS offering, and our Computer Backup Software as a Service (SaaS) offering. B2 Cloud Storage enables customers to store data, developers to build applications, and partners to expand their use cases. The amount of data stored in this cloud service can scale up and down as needed, primarily on a pay-as-you-go basis, or can be paid for on a capacity or committed contract basis for greater predictability. B2 Overdrive is built on the foundation of B2 Cloud Storage. It enables AI and data-driven workloads with up to 1 Tbps throughput, unlimited free egress, and private networking support. Powered by Backblaze is also built on the foundation of B2 Cloud Storage. It enables NeoCloud and application platforms to bolster existing products or expand their product offerings with cloud storage via the Backblaze Partner API and custom domains technology. Computer Backup automatically backs up data from laptops and desktops for businesses and individuals. This cloud backup service offers easily understood, primarily flat-rate pricing to continuously back up a virtually unlimited amount of data. To continue expanding and accelerating our movement up market and aligning to emerging AI-related opportunities, we recently launched B2 Neo and the Backblaze Flamethrower Startup Program. B2 Neo is our white-label, enterprise-grade cloud object storage solution, purpose-built for and with NeoCloud platforms. B2 Neo enables NeoClouds to ship a native, branded storage offering in weeks rather than months, without diverting engineering resources from their core GPU and compute roadmaps. Flamethrower is our founder-first startup program designed for the next generation of AI developers, builders, and entrepreneurs. The program offers up to $100,000 in storage credits, coupled with direct support from the Backblaze team and a community of peers to help startup companies build economically sound businesses at a critical time in their life cycle. Together, these launches reflect our dual motion of capturing large AI supply-side platform relationships at the enterprise level while seeding a developer-led growth pipeline through our self-serve motion. In November 2025, we initiated a restructuring and transformation plan designed primarily to improve the effectiveness and efficiency of our sales and marketing functions in support of our go-to-market objectives. The 2025 Restructuring and Transformation Plan. The 2025 Restructuring and Transformation Plan includes the redesign and implementation of new strategies and processes, organizational realignment and reallocation of resources, and other corporate actions. From inception to date, we have incurred charges of approximately $4.7 million, including employee termination expenses, an impairment charge related to our exit from our corporate headquarters facility, and other transformation costs. For the 3 months ended March 31, 2026, we have incurred charges of approximately $2.2 million, primarily related to employee termination expenses and other transformation costs. We expect to incur additional charges of approximately $2.1 million to $4.3 million through the first quarter of 2027, at which time the 2025 Restructuring and Transformation Plan is expected to be completed. These charges include estimated employee termination expenses of approximately $0.1 million to $0.2 million and other business transformation costs. In the second half of 2025, we initiated a multifaceted go-to-market transformation designed to scale our business more efficiently and further accelerate our movement upmarket. This includes scaling our direct sales organization, enhancing our marketing and demand generation capabilities, and driving expansion within our existing customer base. We are optimizing our direct sales organization to focus on larger enterprise customers and strategic accounts. Our refined go-to-market motion is designed to improve sales productivity while preserving the cost-efficient self-serve model that has historically supported our customer acquisition. We believe effective execution of this transformation will improve customer acquisition efficiency, increase average contract values, and drive long-term revenue growth. Additionally, we are investing in targeted marketing initiatives, including account-based marketing, digital advertising, industry events, and content programs anchored by our blog, case studies, and earned media to increase brand awareness, improve conversion rates, and prioritize higher-value prospects. This disciplined acquisition mix is intended to reduce reliance on promotional or lower-margin license types while cultivating long-term customer relationships that generate referrals and advocacy. Finally, we are focused on expanding revenue within our current customer base through the introduction of new features and use cases, continued enhancement of our customer success programs under new leadership, and the natural growth of customer data stored on our platform. Customers continue to broaden their use of Backblaze for complementary workloads, including media storage, hybrid cloud support, and analytics repositories. We believe the AI era is reshaping the cloud storage landscape and creating opportunities to establish Backblaze in emerging ecosystems where the scale, economics, and openness of our platform are differentiated. We are making targeted investments to position the company in 2 such ecosystems where we see meaningful market potential. Through B2 Neo, our white-label enterprise-grade cloud object storage solution designed for integration with Neo Cloud platforms, we are pursuing the large AI supply-side platform relationships that are emerging as GPU and compute providers seek to offer native, branded storage to their customers. Through the Backblaze Flamethrower program, our founder-first startup initiative, we are working to engage the next generation of AI developers, builders, and entrepreneurs. The program offers up to $100,000 in storage credits, coupled with direct support from the Backblaze team and a community of peers to help startup companies build economically sound businesses at a critical point in their life cycle. We view Flamethrower as a seeding investment in a developer-led growth pipeline that complements our self-serve motion. While our sales and marketing efforts have primarily focused on the United States, our existing customer base spans more than 175 countries, with 28% and 27% of our total revenue originating outside of the United States for the 3 months ended March 31, 2026 and 2025, respectively. We believe international expansion may represent a meaningful opportunity. We may invest in our operations internationally to reach new customers by expanding into targeted key geographies where we believe there are opportunities for significant return on investment. In January 2025, for example, we entered into an agreement with a leading hybrid cloud solutions provider in Canada to extend our market reach in this region. This agreement resulted in the launch of a new data center region in Canada in January 2025. 1. Beginning in the first quarter of 2026, we are presenting the net revenue retention rate on NORR using a single quarter calculation, comparing current quarter revenue to the corresponding prior year quarter, rather than an average of quarterly rates over the prior 4 quarters, in order to provide a more current measure of customer retention. Prior period UNNORR amounts have been recast to conform to the current period presentation. 2. Beginning in the first quarter of 2026, to improve comparability between periods, we revised our methodology for calculating annual recurring revenue, ARR, for our consumption-based arrangements to use a daily revenue rate during the last month of the period rather than a monthly rate. Prior period ARR amounts presented have been recast to conform to the current period presentation. We believe the growth in the use of our platform by our existing customers is an important measure of the health of our business and our future growth prospects. We measure this growth by monitoring our overall net revenue retention rate, which measures our ability to retain and expand revenue from existing customers. The enhancement of our B2 cloud storage offerings is driving significant revenue retention, resulting in NRRs of 110% and 105% as of March 31, 2026 and March 31, 2025, respectively. The decrease in the NRR for computer backup reflects the prior year period benefit from the phased impact of earlier price increases on renewing subscriptions, whereas pricing was stabilized in the NRR as of March 31, 2026. We have maintained gross customer retention rates of approximately 90% across our revenue products as of both March 31, 2026 and March 31, 2025. We believe our high gross customer retention rates demonstrate that we provide a vital service to our customers, as the vast majority of our customers tend to continue to use our platform from one period to the next. Changes to recurring revenue may result from the expansion of our offerings to our existing customers, as well as new customer acquisition and the timing of customer renewals. Our ARR increased by $20.5 million for B2 Cloud Storage as of March 31, 2026, compared to March 31, 2025, representing 28% growth. ARR for computer backup experienced a slight decline of $1.7 million compared to the prior year, but continues to serve as a stable source of recurring revenue, supported by multi-year subscription commitments and increased demand from business environments. Effective May 1, 2026, we implemented changes to our B2 cloud storage pricing, including an increase in pay-as-you-go storage pricing and the elimination of API transaction fees. We expect these changes to impact the mix and level of revenue recognized from consumption-based arrangements in future periods. The overall effect on revenue will depend on customer usage patterns and adoption of our platform, including by customers with more data-intensive workloads. During the second quarter of 2025, we completed a study on the useful lives of our property and equipment, resulting in an extension of the useful life of our infrastructure equipment. The MC depreciation expense of approximately $0.9 million for the 3 months ended March 31, 2026, and is anticipated to result in further reduction of approximately $2.8 million for the remainder of the year ending December 31, 2026, as a result of this change in estimate. In addition, as part of our ongoing go-to-market transformation, we expect sales and marketing expenses to increase as we continue to invest in key initiatives, including a programmatic overhaul of our developer experience focused specifically on the tooling and documentation that serves developers using or building with AI, the launch of Flamethrower, a startup program designed to provide early-stage companies with product credits, technical support, and ecosystem partnerships to drive early adoption and long-term customer growth, and the introduction of B2 Neo, a white-label cloud storage solution designed to expand our reach through enterprise platform partners. Total revenue increased by $4.1 million, or 12%, for the 3 months ended March 31, 2026, compared to the same period in 2025. Primary factors influencing the $4.4 million increase in B2 cloud storage revenue include the following: a $2.7 million increase in sales to new customers, and a $1.7 million increase driven by higher storage usage as a result of upselling and organic growth by existing customers. Primary factors influencing the $0.3 million decrease in computer backup revenue include the following: a $0.9 million decrease from a decline in license counts, a $0.3 million increase from the phased impact of earlier price increases on renewing subscriptions, and a $0.3 million increase driven by increased utilization by existing customers. Primary factors influencing the $0.2 million, or 1% decrease in cost of revenue for the 3 months ended March 31, 2026 compared to the same period in 2025 include the following: a $1.5 million decrease in depreciation expense, primarily due to the extension of the useful life of our infrastructure equipment, a $0.6 million increase, primarily reflecting incremental rent and facility costs associated with expanding our data center footprint to support increased storage capacity, a $0.4 million increase in amortization expense related to capitalized investments in platform enhancements and new software features, increases of $0.1 million each in workforce reduction costs and amortization related to our restructuring activities, and a $0.1 million increase in baseline operating spend. Gross margin was 61% for the 3 months ended March 31, 2026, compared to 56% for the same period in 2025. The increase in our gross margin was primarily driven by higher revenue and lower fixed costs, including reduced depreciation expense resulting from the extension of the useful life of our infrastructure equipment, effective April 1st, 2025, which increased gross margin by approximately 2% for the 3 months ended March 31, 2026. In addition, improved economies of scale related to personnel supporting cost of sales contributed to the increase. These benefits were partially offset by higher variable costs associated with the expansion of our data center spaces. On April 30th, 2026, we entered into an amendment to the credit agreement. The amendment, among other things, extends the maturity date from June 4th, 2027 to June 4th, 2028. Additionally, resets the option that allows the company to extend the maturity date by 1 year, subject to certain conditions, and 3, modifies certain negative covenants, including increasing the limit on share repurchases from up to $10.0 million to up to $15.0 million per fiscal year, and increasing the limit on permitted acquisitions to up to $20.0 million of cash consideration. During the 3 months ended March 31, 2026, we repurchased a total of 189,229 shares of our Class A common stock for $0.8 million. As of March 31, 2026, approximately $7.2 million remained available for repurchases under the program. For the 3 months ended March 31, 2026, cash provided by operating activities was $3.4 million, which resulted from a net loss of $6.1 million, adjusted for non-cash charges of $14.9 million, and net cash outflow of $5.4 million from changes in operating assets and liabilities. Non-cash charges primarily consisted of $6.9 million for stock-based compensation expense, $6.7 million for depreciation and amortization expense, and non-cash lease expense on operating leases of $1.3 million. The net cash outflow from changes in operating assets and liabilities was primarily due to a $2.3 million increase in prepaid expenses and other current assets, primarily due to the timing of prepayments, $1.8 million decrease in operating lease liabilities, reflecting the timing of lease payments, a $1.0 million increase in other assets related to employee sales commissions plan, and a $0.8 million increase in accounts receivable, driven by higher revenue from enterprise customers and the timing of billings and related collections. For the 3 months ended March 31, 2025, cash provided by operating activities was $4.9 million, which resulted from a net loss of $9.3 million, adjusted for non-cash charges of $16.0 million, and net cash outflow of $1.8 million from changes in operating assets and liabilities. Non-cash charges primarily consisted of $7.8 million for depreciation and amortization expense, $7.4 million for stock-based compensation expense, and non-cash lease expense on operating leases of $0.9 million. The net cash outflow from changes in operating assets and liabilities was primarily the result of cash outflows related to a decrease of $1.6 million in operating lease liabilities, as well as an increase in prepaid and other current assets of $1.1 million, each related to the timing of payments of our expenses. The cash outflows were partially offset by a cash inflow due to an increase of $0.8 million in deferred revenue, which increased due to our growing sales and to timing of collections from our customers. Cash provided by investing activities during the 3 months ended March 31, 2026, was $0.3 million, resulting primarily from the following activity: proceeds of $8.0 million from the maturity of our marketable securities, purchases of marketable securities of $5.0 million, cash payments of $2.1 million related to the development of internal use software for adding new features and enhanced functionality to our platform, and cash payments of $0.7 million related to capital expenditures in support of infrastructure deployments to support our growing business. Cash used in investing activities during the 3 months ended March 31, 2025, was $6.1 million, resulting primarily from the following activity: purchases of marketable securities of $18.3 million, cash payments of $2.1 million related to the development of internal use software for adding new features and enhanced functionality to our platform, cash payments of $0.5 million related to capital expenditures in support of infrastructure deployments to support our growing business, and proceeds of $14.8 million from the maturity of our marketable securities. Cash used in financing activities for the 3 months ended March 31, 2026, was $6.6 million, resulting primarily from the following activity: principal payments on our finance lease agreements and lease financing obligations of $4.2 million related to hard drives and other infrastructure equipment used in our data center spaces, $1.8 million related to payments on taxes for net share settlements of vested equity awards, $0.8 million related to repurchases of our Class A common stock, and $0.4 million in proceeds from the exercise of employee stock options. Cash used in financing activities for the 3 months ended March 31, 2025, was $4.0 million, resulting primarily from the following activity: principal payments on our finance lease agreements and lease financing obligations of $4.5 million related to hard drives and other infrastructure equipment used in our data center spaces, $0.5 million related to payments on taxes for net share settlements of vested equity awards, and $1.1 million in proceeds from the exercise of employee stock options. On February 25, 2026, each of Gleb Budman, our Chief Executive Officer, and Mark Suidan, our Chief Financial Officer, adopted a written trading arrangement intended to satisfy the affirmative defense conditions of Rule 10b5-1-Call C under the Exchange Act. Each of these trading arrangements was subsequently terminated on March 31, 2026. On April 30, 2026, we entered into a Second Amendment to credit agreement with Citizens Bank N.A. The Second Amendment. The Second Amendment amends the credit agreement to, among other things, I. Extends the maturity date from June 4th, 2027 to June 4th, 2028. E. Resets the option that allows the company to extend the maturity date by 1 year, subject to certain conditions. And E3 modifies certain negative covenants, including increasing the limit on share repurchases to up to $15.0 million per fiscal year and increasing the limit on permitted acquisitions to permit up to $20.0 million of cash consideration.